I hope you enjoyed that introduction music. It was the Royal Philharmonic Orchestra playing one of Paul McCartney's greatest compositions called Yesterday. I've got also a very pleasant picture for us here, a little family, the little core family going on an overseas holiday. And the reason for that is we're going to start with a new topic today, and this topic deals with foreign exchange. Now, those of you who have traveled overseas will probably have dealt with foreign exchange before. Anyway, most of you would probably have, at one stage or other in your life, you would have stood in your bank and you would have seen there's an area there with the words Bureau de Change. Now, if this had been a live class, if it is a live class, but if this had been a person-to-person class, then all of the students would have asked me, what did you just say, sir? And then I would have said, I said, Bureau de Change. And they would say, what did you just say, sir? I do not understand. Well, it is a French word, and I gave, or a French term, and I gave you the French pronunciation as well. So it is actually, if you would pronounce it in English, it would be Bureau de Change, but the French term is Bureau de Change. So I've got a picture here of one that is at the Cape Town International Airport at the arrivals as well as the departure lounge. So let me just find that for you, and then maybe some of you would then recognize this. Let me just go and have a look. There you go. That look familiar. Have you ever seen that? Those of you who've seen it before somewhere, either in your own bank, and you just use your hands. Precious, wonderful. Precious has seen that before. Precious, say good morning to us. Unmute your microphone and then say good morning to us, please.
Good morning, sir, and good morning to the rest of the class.
Thank you. That one of the things I miss most about not being face-to-face is to hear your voices and to see your pretty faces. Zuleika Williams also said yes, she has seen that before. Thank you. So that is the area of the bank that deals with foreign exchange. There you can literally go and change one currency into another currency. They are very often called the money changers, the money changing department. So there you can, let's say for instance, you are traveling, for argument's sake, to London, and you've got a few rands in your pocket or in your wallet or in your handbag, and you want to change it into pounds there, then you'll go to the Bureau de Change, the Bureau de Change, the money changers. Right, and then you'll hand in your rands there, and they will then exchange it for pounds. And when you return to South Africa, when you arrive in Cape Town and you've got some pounds left in your wallet or in your purse, then you'll go to this one, the one at the Cape International Airport, and then you'll have in your pounds, and they will then exchange it back to rands for you. There are certain businesses who do nothing else. There's, for instance, Thomas Cook. I know that they've got financial troubles at the moment, but Thomas Cook, there are a few others, American Express. So they all deal in foreign exchange. Now, when it comes to foreign exchange, one has to basically realize that you can buy another kind of currency. You can, with your rands, you can buy some dollars, or you can buy some euros, or you can buy some yen if you're going to Japan. If you intend to go on an overseas holiday, then you can buy traveler's checks there. So you use your local currency to buy a foreign currency, and then you take that along with you. Now, I don't know if you've ever seen this when you are there, you can actually see it in the background there, but I'm going to show you a bigger photograph now of that little board there. We call it the ticker board. Let me just find that for us. There's a ticker board for you. Now what happens there? That ticker board actually displays for us what we refer to as the spot exchange rate. What is meant by the spot exchange rate? It means the exchange rate that is prevalent at that specific second, at that point in time. So there at the bottom we can, for instance, see the second from last, there's the South African flag. This is one that is that comes from Britain. There we can see that if you want to purchase a pound sterling, it's going to cost you 16 rand 61 at a particular point in time. And if you want to sell South African rands and you want to purchase pounds, then they would buy your South African rands at 19 rands 23, and if you want to sell your South African rands, then they will give you 16 rands to the pound. And it is quite scary to have a look, not scary, but it is entertaining to have a look at that, because it's not quite like watching grass grow or watching paint dry. There's actually movement. So you will see every few seconds some of those digits change, maybe only by 1 cent or 2 cents at a time, but the exchange rates, they fluctuate. That is the point I'm trying to make here. They are fluctuating at virtually continuously throughout a day. So perhaps at the beginning of the day, you would have been able to buy, let's say, British pound at 19 rands 23 cents, and then in the afternoon, you'll have to buy it at 19 rand 26 cents or 28 cents. So it does change during the course of a day. So the spot exchange rate is the exchange rate that you can get at that particular point in time. Now, this is maybe this part is scary. It can actually fluctuate and vary quite dramatically. The 1 year that stands out to me personally, because I still regret having done that, I used to spend between 6 and 8 weeks a year in Britain for work purposes, and normally I would buy travelers checks up front. I would buy the equivalent of more than 10,000 rands worth of travelers checks up front. So in other words, you know exactly what you are paying for it at that point in time, even before you depart. And you may not believe this, but you can go and check this out if you wish. At that point in time, this was June 1998, beginning of June 1998, the rand pound exchange rate was 4 rand 36. So to purchase 1 British pound sterling would have cost you 4 rand 36. And then that particular year, all the years before that, I used to buy a traveler's checks up front, and that year I decided, no, I'm not going to go to the trouble of buying traveler's checks up front. I'm just going to use my credit card for I think it was about 2 months, 8 weeks that I spent in Britain in that year. And by the end of those 2 months, the rand pound exchange rate was 6 rand 65, right? So it fell from 4 rand 35 to the pound. You would buy 1 pound for 4 rand 35, and then within 2 months, 1 pound would cost you 6 rand 65. So the value of the rand decreased by 50%, just over 50%. So I regretted not having bought travelers checks up front, because when I came back and I had to actually pay my credit card bill, all those acquisitions, all the purchases, all my meals and what have you, the accommodation cost me 50% more in terms of South African rands. Not because it was more pounds, but because it cost me more to buy a pound, right? Okay, so that is the one point I'd like to make, ladies and gents, that fluctuations in your exchange rate do occur. It occurs virtually on a minute by minute basis. Now, when it comes to inventory, and we are going to talk about a combination of inventory and foreign exchange, you know from financial accounting what is the situation when you actually acquire inventory, right? If you are using the perpetual inventory system, you know that you are going to be debiting your inventory account. If you are using a periodic inventory system, then you know that you are going to be accumulating the purchases during the course of your financial year on a purchases account, right? But when it comes to local purchases, if you purchase your inventory locally, then there are two things that makes the recording and calculation of those purchase transactions actually very easy. The one being that you are paying your supplier in the same currency as the currency in your bank account, right? You don't have to change whatever currency you are using in your bank to another currency. So that is the one thing that makes that quite straightforward. The other thing that we must realize is that when you are procuring something locally, if you are purchasing something, even if you are going to purchase it from Durban or Johannesburg, it can still reach you within a day, if not even the same day, right? So it reaches you very soon. But when it comes to importing inventory, very often it takes quite long to reach you. For instance, ladies and gents, let's maybe we spoke about aircraft a lot when we spoke about property, plant, and equipment. Now, when it comes to cargo aircraft, when you are importing something or exporting for that matter, but we are going to be focusing on the perspective of an importer, so you are the customer, then you pay according to the weight of the items that you are going to place on that cargo plane, right? Remember, a plane must take off, as we know, right? So the weight is the thing that determines the cost of your freight. In the case of a ship, if you are going to transport something by ship, then it is not the weight that is going to determine the cost of your freight, because weight becomes almost immaterial, because you know those big rigs are enormous, but it is the space that it takes up. Now, if you are importing something that is fairly lightweight, so let's say for instance it is clothing or shoes, yes, then you can probably ask the supplier or request the supplier to put it on a cargo plane. And even if it's from London, you can have it overnight. You can have it within 24 hours. Or if it's from Japan, you can have it within maybe 30 hours. From the United States, it can reach you within 30 hours. Let me just find a picture that I used. Was it the week before last? I'm just going to ask you something then. What about this one? Let me just find it. Do you think this particular item, I'm just going to need to share it with you. Do you think this particular item, if you are going to import it, would you be able to import it by means of an aircraft, a cargo aircraft, or will this have to come by ship? Somebody can type for me there. Aircraft or ship? Or you can say it. You can unmute your mic like Precious did earlier. Ship or aircraft? Yes, Zuleika. Yes, Lelwa. Yes, Patience. Yes, Erasmus. Ship. Why? Because that thing weighs tons, right? Definitely ship. Well, first of all, I don't think there's an aircraft that is going to be big enough for that specialized mining vehicle to fit in. So that is our first problem. No aircraft is going to be large enough for it to fit in. And even if there was an aircraft that is large enough for it to fit in, that aircraft would then be so heavily laden, it can probably not take off. I know that the Boeing 747s, those four-engine aircraft, I think the maximum weight that they can carry is 350 tons, 350,000 kilograms. Now that thing, I'm not saying it weighs that much, but it is pretty heavy. Very good question that, Koketso. Don't they send parts, sir? Then it is assembled here. That is very clever. That is very clever. That could possibly happen. I think that is probably what happens, is that they will send the various significant parts to South Africa. So we import them from the United States, and then we assemble it here. But even those individual parts, if you think about that iron, that is extremely heavy. So I would say even those parts, even equally heavy. I know it's not as heavy as the whole assembled thing, but they are going to be, the price that you are going to pay because of their weight. Remember we said that when you transport something by aircraft, you pay by weight. So the weight is going to be so much that if you import that by means of an aircraft, that thing is going to be 10 times more expensive than it would be if you just assemble it and put it, or even if you don't assemble it overseas, if you just import it by ship. You've all seen these huge containers. If you drive with the N1 towards Cape Town City Bowl, then on your left-hand side, 4 kilometers and kilometers, you see these huge shipping containers. One of the biggest shipping and freight companies in the world, Maersk. I'm not sure if it's a Finnish or a Swedish company, but anyway, you would have seen Maersk, Maersk. And then I can't remember the rest of the name of the company. C something, Mark, C something. Anyway, you'd have seen those huge containers. So those are the containers that are being loaded on ships. So if you want to export something, then you put all the stuff you want to export into those containers. Eventually, those containers loaded onto a ship. But anyway, to cut a long story short, the point that I'm trying to make here is that if you are going to import something by ship, then if you import it, let's say from Britain, it's not going to reach you in Cape Town within 24 hours or within 48 hours. It's going to reach you maybe within a week or two, right? And then if there's a storm at sea and they have to find some protection in a port, that may delay it even further. So you may have a situation where you are ordering goods from a foreign supplier today, but those goods are only going to reach you, let's say, in 15 or 16 days time, or even longer in certain cases, right? And in that period of time, it is possible that the exchange rate has fluctuated, so that the amount that you believe that you are going to be paying is going to be much more, not because it's a different purchase price, but because when you are eventually going to pay the purchase price, if you have purchased it on credit, then that foreign exchange is going to cost you more, right? So that is the point, what I'm making there. So there might be a big delay between the date that you order the goods and the date that the goods actually arrive. Now, another little point that I'd just like to make here, and today is really an introduction. I think we even called this session an introduction to foreign exchange. So this is just talking about foreign exchange in general. Let me just stop sharing that. So if you are going to, let's say you are overseas and you purchase something in a shop, I'm making this very simple, and then we're going to take the argument a little bit further. If you are in England, if you are in London, for instance, and you are going to buy something there, in which currency will you have to pay that shop that you are buying at? In rands or in pounds? Type for me, please. In pounds. Thank you, Kolelwa. You'll have to pay in pounds. That is why we've got the money changes. Thank you, Gillian. Thank you, Precious. Thank you, Hona. So you'll have to exchange your rands at one of those money changes before you actually go on a shopping spree or before you go to the restaurants, because they wouldn't want your rands, because that gives them extra effort. They will have to go and exchange. They will say, no. You're in my country, you pay my kind of money. Okay. So the point is that you have to exchange the money before you actually go buying anything. Now, what I want to ask you here, and this is also part of what we are working towards. If you are now going to import items from anywhere in the world, it might be the USA or Britain or Australia or Germany for that matter. If you are going to be importing stuff, you are going to be ordering from a foreign supplier. And maybe before we even take the argument further, what kind of document do you get from any supplier to tell you what the transaction is worth, what you owe them? Please type for me there. You all know it from Financial Accounting 1. You probably now know it from Auditing 2 as well. What document will your supplier give you to tell you this is what you owe me for the transaction? What do we call that document? There we go, Zuki. Perfect. A tax invoice, right? A tax invoice. Or I know that is specifically the word tax invoice comes from when value-added tax was introduced. Invoice. Generally, we just talk about an invoice, but tax invoice is the correct one locally. So Zuki is 100% correct. The rest of you are also 100% correct. Thank you, Koketsu. Thank you, Kolelwa. So it's an invoice. Now, what I'm going to ask you now, if you import something from a foreign supplier, will that foreign supplier give you an invoice in their currency where their business is, or will they give you an invoice in your currency? Your currency or their currency? Let's make it practical. If you're importing something from, let's say, the United States of America, their currency. Thank you, Zuleika. There you've got the answer. So just to make it practical, their currency. Thank you, Anna. So if you are importing from the United States of America, they're not going to give you an invoice in rands, right? They're not going to give invoices to all their customers all over the world in their customers' currency. They're going to produce an invoice and give you an invoice in their currency, right? So that means if I'm importing something from the United States, I'm going to get an invoice that is denominated in US dollars. Or if I'm importing something from Italy, nice Italian shoes or a beautiful Italian suit, which I can't obviously afford, just cheap suits on my side, then I'm going to get an invoice in euro. Or if I'm importing something from Great Britain, like you've answered there already, then I'm going to get an invoice in pounds. Or if I'm importing something from Japan, I'm going to get an invoice in yen. Right, so they are going to tell me what I owe them for that particular transaction in their currency. And then I have to convert it to, eventually when I'm going to record this transaction, I have to convert it to the local currency. In other words, our reporting currency at the exchange rate at that point in time, right? And then later on, when I actually pay the suppliers, I'll have to go and do that again, because now I have to do a funds transfer to the supplier in their country, which means that the money, the physical money, will then have to be converted at the exchange rate at that particular point in time. So, ladies and gents, I'm just going to disappear here from the my profile picture will still be there, but I just want to now share a blank document with you. I use these blank Word documents instead of a whiteboard. The reason for it, I think I might have mentioned this a while ago. When it comes to the whiteboard, you can only see what I'm typing once I move away from it. Whereas if I use Excel or Word or something like that, then you can actually see it in real time as I type it. Okay, so there we've got our blank whiteboard. So, ladies and gentlemen, when it comes to financial accounting in general, we all know that dates are very important, right? Mr. Borman always draws that timeline, which is a fantastic illustration of financial years and what happens during the course of a financial year and so on. But when it comes to foreign exchange transactions, it is even more important. Your dates are extremely important, and I guess you can see why, because the exchange rate fluctuates. The exchange rates fluctuate on a by-minute basis. I'm not even talking about a day-by-day basis. On a day-by-day basis, they can fluctuate tremendously. So, ladies and gentlemen, when it comes to the dates, if we are talking about foreign exchange transactions, there are basically three dates that are extremely important to us. The first date, perhaps I can still, no, I don't want to share my face at the moment. The three dates that are important are, first of all, the transaction date. The transaction date. Now that may sound fairly simple to you if it's a local transaction. If you're not importing anything, then the transaction date is actually pretty easy. You'll know this from auditing, internal auditing 2. You'll know it from financial accounting 1. The transaction date is when you get the benefits and the responsibilities for the asset. Right, as soon as you assume the benefits or responsibilities for the asset, then you have become the legal owner, right? And that is when the transaction is deemed to have taken place. Again, let's maybe just make it practical. If you are going to purchase something, some of your inventory from a local supplier, and you are going to fetch it, from the supplier's warehouse, it means the minute that you take custody of the goods, it becomes your property, and that will then be the transaction date, because now you are responsible for the goods, but you've also got the benefits of ownership. Or, ladies and gents, let's say your supplier is going to deliver the goods to you. Then as soon as the goods arrive at your premises and the supplier's delivery people hand it over to you, and your people who are receiving the goods, they sign the supplier's delivery note, that signature means that you have taken custody of the inventory that you have purchased. So suddenly the inventory now belongs to you. You have the benefits of ownership, but you also have the responsibilities of ownership. Why I'm emphasizing the word responsibility, you must remember, you learn this in auditing and in internal auditing as well. When it comes to owning something, you've got to protect your property, right? You've got to protect it now against theft, or you must protect it against damage, for instance, right? So you've got the responsibility of ownership, but obviously then also the benefit of ownership. But when it comes to a foreign exchange transaction, that is not actually so easy, because there are many possibilities, and I'm going to talk about at least 4 possibilities a little bit later, of when we can deem the transaction to have taken place. But I'm going to give you a few thoughts already. When do you think, and I know this is a trick question, we'll answer them later on, when do you think would be the appropriate time for you to be getting the benefits as well as the responsibilities of ownership? When you order the goods, or when the supplier loads the good onto a ship in the foreign port, that is the port of origin, or when the goods arrive at your local port, the destination port, or is it perhaps only when it's cleared by customs, or is it perhaps only when we pay the supplier? When do we become the legal owners of the inventory that we are importing? So that, ladies and gentlemen, when we become the legal owner, when we assume the responsibility for those goods and we then reap the benefits of ownership, that is what is going to be the transaction date. So that is the date when we are going to record the purchase, right? That is when we record the purchase. Then, ladies and gents, another date, and I know this is also important in local transactions. It's just more complicated when it comes to foreign transactions. That is why we are dealing with this topic. Then the other date that is important is our settlement date. Settlement date. What is the settlement date? Perhaps you can type for me. What do we mean if we talk about the settlement date? What happens on the settlement date? We do what? Yes. Thank you, Mklanga. You didn't even need a question mark. Yes, that is when you pay. So the settlement date is when you make a payment to your supplier. It could be settlement in full. In other words, you pay for that whole transaction or the whole balance outstanding, or it could be a partial settlement. So, right, you're paying on the account, but not the full amount on the account. But the fact remains, the settlement date is when we are making, like Mhlanga said there, we are making a payment. Then, ladies and gentlemen, what complicates foreign exchange transactions even a little bit more is that you must remember, you also know this from auditing, but you also know it from financial accounting. When it comes to your reporting date, so now we're talking about the financial year end. When you draw up your financial statements, you know that the financial statements must be a fair presentation. This comes from IAS 1, which we've dealt with quite recently, also at the beginning of the year for some. So it must be a fair presentation of what? The results or the performance of the company, as we know, its cash flows, and then what's the third thing? If you can type for me there as well, please. It must also be a fair presentation of the company's what? Besides performance and results, besides cash flows, a fair presentation of its financial, come on, type the second word, of its financial what? We've got a statement called that. Position. Thank you, Kim. So it must also be a fair presentation of the company's financial position. That is why we have a statement of financial position. So now you can imagine, ladies and gentlemen, if we've recorded purchase transactions earlier in the month, right? Or perhaps even the month before, and now we've got a financial year end and we have to draw up, amongst others, a statement of financial position. That statement of financial position must be a fair presentation of the company's affairs, you know, the picture snapshot of its financial position. So if you have any foreign denominated assets, or for that matter, any foreign denominated liabilities, that means you have to, if you want to show a fair presentation of its actual value or the outstanding balance at the reporting date, it means you will also have to convert that amount that is denominated in a foreign currency into your reporting currency. We are going to be focusing on suppliers, but this does relate to any other kind of liability or asset for that matter, if it's foreign denominated. So if you, in the situation that we are dealing with, if you have then a supplier, a creditor, that you owe money in terms of pounds or in terms of dollars or in terms of euros or yen or whatever it may be, then it means you'll have to also convert that amount outstanding, because you remember you're sitting with an invoice that is denominated in a different currency. It means you have to convert it at the year-end date or the reporting date. So that is the third date. That could be very important for us, the reporting date, right? So the transaction date, settlement date, and then if there is a reporting date between those two, then the reporting date also becomes important. Perhaps I must just change the order there. So I'm going to cut that, and I'm going to put that below that. So first of all, we'll have the transaction date. That is the date that we have become the owners of the goods. Then later on, we have the settlement date. That is when we are going to pay either in full or partially the money that we owe to the supplier. And then if there is a reporting date between those two dates, between the transaction date and the settlement date, the reporting date is also important, because that is then another date in which we will have to convert our foreign denominated creditor into our reporting currency. Remember, if we are a company or a business in South Africa, we draw up financial statements in our currency, right? So we draw it up in rand. So any foreign denominated asset or liability must be reported in terms of rand. So it means at that reporting date, we must also convert it. Okay, ladies and gents, let's just pause there for a little while. Are there any questions from your side? You are most welcome. Like I said earlier, I would really like to hear you. If you are, I'd like to see your faces. You can switch on your camera as well. Any questions so far? Or you can type it. Board, I think they call it a ticker board, like it ticks over, it ticks. I think they call it a ticker board, if I remember correctly, because it's got those little electronic digits that as the currencies fluctuate, they change it in real time. How many marks is this part in the exam? Oh, Erasmus, now I've got no idea. Probably about I'm guessing, right? I think it might be about a third of the final paper. I'm not sure. Maybe Mr. Borman or Mrs. Moore can help us out with that. So roughly, I would say about a third of your August paper. Okay, ladies and gents, now the reporting date. We know the reporting date. That is very easy. That is the last day of your financial year. The settlement date, that is also fairly easy. That is the date that you are going to be arranging with your bank to transfer money out of your rand-denominated account into a foreign bank account in Britain or Japan or wherever. Right. So thank you, Mrs. Moore. There's an indication there. The big issue here now is the transaction date. How do we deem the transaction date? How do we decide when are we going to record the purchase? Now there are quite a number of ways in which this can be done. We are going to be talking about the four most commonly used methods in international trade. And one thing we must remember here, it is simply a matter of negotiation. You negotiate as a customer with your supplier which of the methods we are going to be using. Now, I have one of the world's worst artists. I've got no artistic ability, so I'm not even going to try and draw anything, but I'm going to just give you a schematical or some sort of depiction of what actually happens. So let's maybe just start there by saying foreign supplier. You are going to be ordering something from the foreign supplier, right? So the foreign supplier will then put the stuff that you are ordering. They're going to package it. They're most probably going to put it in one of those big containers. So they're going to package it, and then they are going to load it on the ship or the aircraft. The ship or the aircraft that is going to transport it to your country, right? So the foreign must first of all go and load it. Ship in the port. And if I say port, this could be an airport or it could be a seaport, right? Airport or seaport. So load on a ship or an aircraft for that matter in the port of origin. So let's, just for making it practical, let's say we're talking about London in England again, right? So they have to now go and put it on a ship. Then what happens after that, ladies and gents? I'm just going to, like I say, I'm not a good artist, but I'm going to try and give you just an indication here. Then the ship is going to depart. And it's going to be sailing for a few days on the sea, or flying in the air for that matter. Okay. If it's an aircraft, it's going to be in the air. If it's from London for about 11 hours, 10 and a half to 11 hours. If it's from Singapore, it's going to be about 16 hours that it's in the air. But if it's coming by ship from London, it's going to be about 8 or 9 days. Okay. Then eventually, the ship reaches its port of destination. What did I call one? Port of origin. So let's call this reaches port of destination. Port of destination, right? So it reaches the port. Now, what happens in reality, ladies and gentlemen, those ports, like Cape Town's port, is pretty busy. It's pretty busy. So you may find the ship reaches the destination, but it might have to wait a day or sometimes even 2 days outside of the harbor, right? Because the harbor is pretty busy. So they'll have to wait their turn. So eventually, one of those tugboats or more than one of the tugboats will come and fetch them when it's their turn, and the tugboat will pull the ship into the harbor, make it dock, and so forth. And then once it's docked, what happens then? The goods are goods. The goods are loaded off from the ship. And where do the goods go before you can come and fetch the goods? Where do the goods go first? They go to whose warehouse? We've spoken about this a while ago. If you can type for me there, whose warehouse does it go to? It's a sub-department of the South African Revenue Service. Customs, thank you, Koketso. Michael Koketso, thank you. Yes, it goes to customs first, because now, as we've spoken about some time ago, now they first got to see whether it doesn't contain contraband. Doesn't it contain dangerous arms, or it doesn't contain illegal drugs or anything like that. You'll know from when we did the determining the cost of an asset. Once they've determined that the goods are not contraband, they're going to slap a tax on it, right? They're going to tax you, which we call import duty. So the goods are loaded off from the ship. It goes to the customs warehouse. Oops, not warehouse. There we go. Then once customs, the customs officials, once they have looked at the goods, they've calculated your import duties, then they will release it to you as the customer. So then they will release it. Okay, so there we can see there are quite a number of things that happened. The goods must first be loaded on the ship. The ship will then depart. It'll spend some time at sea. It'll reach its port of destination. Then the goods will at some point in time be loaded off from the ship. It'll go to the customs warehouse, and then eventually customs will release it to us as customers. So now we've got to ask ourselves the question, if we want to record the purchase, in other words, if we want to determine the transaction, how are we going to do it? Is it going to be the day that we are ordering it from the customer? No, we all know that doesn't happen in local transactions or foreign transactions. So that's something that we don't even have to worry about. Is it the day that the supplier loads the goods within a container? That is also not one of them. But now we are getting to some possibilities, and we've got to negotiate this with our supplier. Will it be when they load the goods on board of the ship? Because now neither of us, neither the seller nor us as purchasers, now we don't have control of the goods at all. Remember, now for that period of time that the goods are on board the ship, it's not under the control of the supplier anymore, but it's not under our control either. So who's responsible for it now? We spoke about the responsibility as well as the rewards of ownership, but who's responsible for it now? Is it the supplier or is it us as customers? We've got to decide. So we've got to negotiate that with the supplier. If we go down to where we spoke about customs, whose responsibility is it to get the goods loaded off from the ship? Whose responsibility is it to get it to the warehouse, the customs warehouse? Whose responsibility is it to go and pay the import duties? Is it ours or is it the suppliers? That's got to be determined. So you have to negotiate with the supplier. You're going to decide which method you're going to be using. Now, I'm aware of 5 methods. Let me just have a look. I heard somebody typing something there. It's Mr. Borman. Thank you. Mr. Borman is giving you a lot of good feedback there. Okay, so I'm aware of 5 possibilities, but there are 4 that are used in possibly 99% of cases. So I'm going to type the 4 possibilities, or 4 of the 5 possibilities here. Those are the ones that, like I say, is probably used in 99.9% of foreign currency transaction. The first is what we refer to as the SOB. No, I'm making a mistake. It's not an SOB. That stands for something else. It's FOB. So the first possibility is the free on board. Free on board method. The free on board method. Now, ladies and gents, one thing that we have to understand here, and if you understand that, all this becomes actually pretty easy. What you have to understand here, all of these terms, and we are going to use 4 different terms now, all of these terms are seen from the perspective of the supplier, right? It is seen from the perspective of or viewpoint of the supplier. So the first is called free on board or the FOB system. What that comes down to, ladies and gents, is if you negotiate the free on board system or the FOB system with your foreign supplier, then from their point of view, they are free of any responsibilities, right? Are free of any responsibilities regarding the inventory or the goods that you are ordering the minute that it is on board the ship, or the minute that it is on board the aircraft, right? So from the perspective of the supplier, that is why the name is called the free on board system. They are free of responsibility as soon as the goods have been loaded on board the ship. So that means, ladies and gentlemen, in turn, that you as the importer, you as the customer, has now assumed responsibility for the goods, right? So in that case, ladies and gentlemen, if you have negotiated the free on board system, it means the rewards as well as the responsibility of ownership has now settled on you the minute that the goods have been loaded on board the ship in the foreign port, the port where it's going to be coming from. That means the transaction date, the date that we then deem to be the purchase date, will be the date on which the goods have been loaded on board the ship. Right. Then we've got another method that is very, very popular. It is called the carriage insurance freight. Carriage insurance freight, also known as the CIF system. Carriage insurance freight. Once again, what we have to understand here is that this is seen from the perspective of who. Type for me, let's see if you remember all of these terms from the perspective of who, the supplier or the customer. Type for me, please. Supplier. Thank you, Anna. Thank you, Patience. Yes, thank you, Zuki. So it's from the perspective of the supplier. So if this method has been negotiated, that means the supplier is responsible for carriage, insurance, and freight. So the supplier is going to remain responsible for the goods while the goods are at sea, right? The supplier must arrange that there's insurance on the goods, not the supplier, because this is from the perspective of the supplier. The supplier must get a freight agent, someone who is going to come and make the arrangements with the ship that the goods are going to be transported. The supplier must pay the carriage and the insurance and the freight charges. So it's all the responsibility of the supplier until those goods reach the port of destination. So as soon as it reaches the port of destination, in our case, let's say Cape Town, then the responsibility of the supplier is over and done with. Now it becomes our responsibility, right? So when will the reporting date be deemed? Not the reporting date, sorry, the transaction date. The transaction date, the date that we become the legal owners, when we become responsible for the goods, will then not be when the goods have been loaded on board the ship in the port of origin. Now it will only be when it reaches the port of destination. So not when it was loaded in London, now it is when it reaches Cape Town, right? So that is what that particular one means. Then we've got a third possibility that we can negotiate, and that is delivered at terminal. Delivered at terminal, and I think they usually use the abbreviation DAT. The DAT method, right? Delivered at terminal. So what does that mean? It means, ladies and gentlemen, and again, you don't have to type it this time around. Remember, these terms are seen from the perspective of the supplier, the foreign supplier. So if you have negotiated the delivered at terminal method, then it means the supplier remains responsible for the goods, not only until when the goods reach the port of destination. they remain responsible for it even after it's been loaded off from the ship until it reaches the customs warehouse. We often refer to it is now, what is the term now? Now I forget. It is now on shore. That's the term that we use. So the goods are now on shore. It's not on sea anymore. The goods are on shore. So the supplier remains responsible for the care of the goods until it is on shore. So only when the goods are actually loaded off from the ship, and it is then at the same time being delivered to the customs warehouse, then the supplier remain responsible for the goods until it reaches the customs warehouse. Right. So it means that our date, the transaction date, is going to be deemed the date when the goods are loaded off from the ship. And where does it go? It goes to the customs warehouse. Right. Then a fourth method that we can negotiate, ladies and gents, is what we refer to as delivered duty paid. DDP method, right? Delivered duty paid. What does that mean? Again, we must remember this is all from the perspective of the supplier, right? From the supplier. So that means the supplier remains responsible for the goods, not only until it's loaded on board the ship, not only until it reaches the port of destination, not only until it reaches the customs warehouse, but until when? Until it is being released by the customs, right? Until it's released by customs. In other words, who's going to pay the import duties? This is called the import duties. Type that for me there. The supplier or the customer. If we have negotiated the DDP method. Supplier. I was just thinking now when I was looking there that Anna, as well as Patience, as well as Zuki, you could have just copied your previous answer and pasted there in the text box. Yes, so that remains the responsibility of the supplier. If we had used the FOB or CIF or the DAT method, then us as customers would have paid the import duties. But if we have arranged the delivered duty paid method with our supplier, the supplier remains responsible for the goods until we can actually access the goods. We can take the goods from the customs warehouse. We can put it on our trucks and we can move it, we can transport it to our warehouse or to our shop, to our premises, right? So those are the four methods that we can negotiate, and all of them determine what? It determines the transaction date. In other words, the date that we are going to use in recording the purchase of that inventory. Right. Okay. So let's pause for a little while here, ladies and gentlemen. Are there any questions from your side? You are welcome to type it, or even more welcome to unmute your microphone, ask it in person. Like I've said before, I'm actually missing the fact that I can hear you as well. I want to hear you. Erasmus asks, will there be any quizzes on Blackboard regarding this? Mr. Borman answered, I was just about to say, Mr. Borman is the quiz master. Mr. Borman is the quiz master. So if the quiz master wants to draw up some quizzes, but there you've got your answer. The quiz master, no. But there are obvious questions that I don't know if you've actually looked at it yet, ladies and gentlemen, but if you look at it's not on Blackboard yet, but those who physically received it, I must still ask Mr. Borman if just to give me some assistance with separating the the cash flow and the foreign exchange parts of that handout. But at the end, towards the end of the cash flow handout, you will see there are various questions on foreign exchange. I think Mr. Borman might actually be talking about this a little later. I'm actually running out of my own time. So Mr. Borman will talk about that. So there are questions there. There are also last year's formal test. No, last year it wasn't part of the course. But anyway, there are many questions that you will be able to work through. Then Sisibo asks, the carriage insurance freight is the supplier's responsibility until when of the goods? Sisibo, until the goods reaches the port of destination. It doesn't have to be offloaded yet, but it is this one, when it reaches the port of destination. So the CIF, or carriage insurance freight, the supplier remains responsible until it reaches the port where it is going to be offloaded, the port in the country of the customer. Does that answer your question, Sisipo? Okay. Now, like I said, I'm already 2 minutes over my time, so I'm just going to spend another few minutes. So how are exchange rates quoted, ladies and gents? They are quoted one exchange rate as opposed to the other. So let's maybe just type a few possibilities here. It could be, let's say, like that. $1 times $1 costs us 15 rand. So, ladies and gentlemen, if you can I'm just going to do a few short sums here. If that is our spot exchange rate, right? If that is our spot exchange rate, and we get an invoice, let's say we get an invoice from a supplier to this value. We get an invoice from the supplier for $10,000. And remember, that is the invoice that we get in their currency. They're not going to do us a heck of a favor and suddenly give out an invoice in our currency or for all the various other customers. So now just work it out for me. If you've got you don't need a calculator for this, but if you have a calculator handy, it might help. If you are going to get that invoice, and if you deem today to be your transaction day, what will be the amount of the purchase? In Flanga has already typed there. Anna has typed there. Patience has typed there. How did you get that? How did you get that? Let me share this little calculator. How did you get that? Let me just go to share again. Right, so there we've got a calculator. So what we've done, we've said, what is the value of the invoice? Yes, thank you, Patience, quite correct. So you're going to take $10,000 is the value of your invoice, right? Multiplied by how much does each dollar going to cost you? Each dollar is going to cost you 15 rands, right? So that means the value, the purchase price. Remember, we spoke about purchase price the other day as well. So the purchase price is going to be 150,000 rands, and you have to convert it on the date that you deem to be the purchase date, the transaction date, because you have to report it eventually in terms of rands, right? Your reporting currency is rands. That is what your books of account is denominated in. Okay, so I can clear that. Right, I haven't gone too much over my time. Ladies and gents, so I'm just going to ask you now briefly, any questions on this so far? This is the background for us. Then I'm going to tune out, and if I'm not mistaken, Mr. Borman is going to take over. So any questions from your side? That's the background. Now we're going to start looking at real situations where we have to calculate the purchase price. We have to convert it into our local currency. We might have to draw up financial statements, so we might have to convert the outstanding creditor as at the final day of our financial year. We might have to then go and phone the manager of the foreign exchange department and say, hey, I need to pay $10,000 to my suppliers in the United States. What is $1 going to cost me? And then that manager of the foreign exchange department will say, it's going to cost you today, if I do the transfer, it's going to cost you 15 rands 50 cents, right? Not 15 rand anymore. Now the exchange rand is 15.50. Or it might, if the rand is strengthened against the dollar, you might say a dollar now only is going to cost us 14 rand 20, right? And then the manager will say, okay, send me an email to confirm, and I'll transfer the money out of your account at let's say Netbank into the Chase Manhattan Bank in the United States of America. Right, so then we have to convert it again. Okay, any questions from your side? Okay, then if there are no questions, then I'm signing out for today. And Mr. Borman, are you going to continue?
Yes, Mr. van Rensburg, I'm ready. Are you going to take a new recording, or are you going to go on with the current recording?
I think because it's the same topic, I think I'll just keep the same recording going. If it's okay with you, or I can start.
That's fine with me. That's fine.
Right now,
Okay.
I can have my coffee further.
I'm just going to share quickly the handout on property, plant, and equipment. Is this clear on the screen? Handout on inventory.
Yes, it is.
Right. Ladies and gentlemen, handout on inventory is part of your cash flow handout. And if we just go up, it starts with page 1, where you have Financial Accounting 2 2020, Statement of Cash Flow. And that's the topic we're going to do next term after our test. So the beginning of next term, we start with cash flow. And if you go down to page 47, you will see there's question 1, Mickey Mouse Limited in Somerset West. And this part of the cash flow is only when you, this part of inventory is only when you buy inventory from a foreign destination. And all of these questions will have solutions. They are all there, and we're going to work through them, and we're going to explain them in the next week or two. And you will see there's also notes on the free on board and delivery at terminal terminology. And as I've shown on Blackboard in the comments, in the chat column, on page 958 of your textbook, these terms are also explained. Right. We have how many questions? 3, 4, 5 questions. Question 5 doesn't have a solution. You will do that question 5 on your own, and then we'll discuss it at the end of this topic. Right, let's go out of this one. And I'd like to share the work program. Right, there's the work program. Can you see it? As you can see there, last week, actually the previous week, we should have completed with class test 3, but we've done our class test 3 last week. And we should have been last week already busy with inventory. Right, you have to go and read up in gripping GARP, the recognition and classification of inventory and initial measurement. This is now in the work program 2020 COVID-19 Work Plan Financial Accounting 2 version 4, which is on Blackboard. Now, as you will see, we have about 2 weeks now to do that, and our assessment week starts on the 28th of September. As far as I have seen from the preliminary test week timetable, on the 7th of October, you will be writing Financial Accounting 2 online. So that's in the last week of the test week. You will be writing your formal test 3 on property, plant and equipment. It will only deal on property, plant and equipment. And then in the next term, we will still do a little bit of revision on foreign exchange, but we'll start actually in that first week on cash flows. And your class test 4 on foreign transactions would be on the 23rd of October, and on that Friday. So prepare yourself to write at that stage a class test on foreign transactions. Right, I'm finished sharing this one. And if we now go back, and I suppose you'd like to see my face. The next thing I'm going to share with you. Is my notes on foreign currency transactions. Now, ladies and gentlemen, today we're not going to go into DUT or delivery at terminal and CFOB and CFI. We're just going to look at a practical example, and we're going to look at what does foreign currency transactions entail. In this section, we will look at the effect a transaction. In this section, we will look at the effect a transaction that is denominated in a foreign currency has on the initial recognition and measurement of the transaction, and secondly, the subsequent measurement of the transaction. So, ladies and gentlemen, if your invoice is denominated in a foreign currency, then it will have certain effects on your initial recognition and the measurement of your inventory, and then also in the subsequent measurement of your debt, there will be some effects relating to the foreign currency which change, the exchange rate change, as Mr. van Rensburg mentioned in the previous class. Right, exchange rate and quotes. To be able to account for foreign currency transactions, we must understand how exchange rates are quoted. An exchange rate is the price of one currency in another currency. Now, last night, when I was preparing for this class, I went to the internet and I offloaded what is $1 worth in South African Rand, ZAR, that's the South African Rand. And that was now around about 6 o'clock. And they said, welcome to dollar to South African Rand page. Update every minute between Sunday, 2200 hours, and Friday, 2200 hours. So every minute from Sunday, 10 o'clock, till Friday, 10 o'clock in the evening, they update the currency. So what does this mean? For each 1 Rand US dollar, we have to pay 16,729 Rand. So 16 Rand, 72.9 cent. So if you want to buy $1, now as Mr. van Rensburg explained, you've got a purchase price and a seller's price. But just in lame terms, if you would like to exchange it, you will more or less pay for $1, 16,729 Rand, ZAR Rand. And this was the quote as yesterday afternoon. We have two currencies, a local currency, Rand, and a foreign currency, dollar. And we're going to look at today's examples just at Rand and dollar currencies. Once you sort of get the swing of it, we're going to go into yen and pound and whatever. Now, remember, exchange rate quote is an exchange rate is the price of one currency, the US dollar, the price of one US dollar in another currency, the Rand value, the current currency of, or the local currency is the Rand value. So a direct quote of the exchange rate would be $1 is equal to, and I've rounded it off to 17 Rand, just for making it very easy for our calculation purposes today. Dollar is the foreign currency and Rand is the local currency. So when it's a direct quote, you have your foreign currency first of all, and your local currency second of all. Thus, exchange rate quoted directly is foreign currency first and then your local currency. This effectively means that if you would like to purchase 1 unit of the foreign currency, and this is where it comes in, if you'd like to purchase 1 unit of the foreign currency, you would have to pay 18 or 17 units of the local currency. In this case, you'll have to pay 17 rand of the local currency. Are we all clear on that? If the exchange rate was quoted indirectly, then it would be shown as, first of all, local currency and then foreign currency. So, if we have to express the local currency in relation to the foreign currency, we would say, okay, foreign currency is $1, and if we would like to express it in rand, 0,05882 cent is equal to $1. Now, ladies and gentlemen, you don't have to really worry about the indirect quote, but it's just for interesting sake. The textbook explains the direct quote and the indirect quote. We will give you the quote, and you don't have to worry about whether it's direct or indirect. I've got here also something else which I looked up on the internet last night. I've looked up what is €1 worth in rand. So it says the direct quote, €1 is equal to 19 rand 82 cent. Or if you quote it indirectly, you can calculate it. 0,050444086 cent is equal to €1. Right, so now we go to example number 1. And in this example, we're just going to convert a debt in dollar into a rand value. And we have here spot rates on the 1st of November, on the 1st of December, and on the 31st of December, which is also the financial year end. And this question has got 3 sections. Right, let's just look at the question. On the 1st of November, Selfie Limited purchased inventory from an American company, USA Limited, for $20. It was on the invoice, there was an amount of $20. So, ladies and gentlemen, that means that USA Limited, if you have to pay USA Limited, you have to pay them $20. They're not really worried about how much rand you have to pay up to get $20. But eventually, when you pay, you will pay $20. So if you are going to pay on the 1st of November, you're going to use the exchange rate or the spot rate of $1 is equal to 18 rand. And you're going to pay $20 with the exchange rate. But if you're going to pay on the 1st of December your debt, you're still going to pay $20. But because there is a fluctuation in the exchange rate, you're going to pay another amount in rand value. And if you're going to pay on the 31st of December, there's again another amount you're going to pay. You're going to pay $20 in their money, but rand-wise, it's going to cost you more or it's going to cost you less. Now, if we look at the rand value, on the 1st of November, $1 is equal to 18 rand. That means you have to give 18 rand for each dollar debt. On the 1st of December, things have changed. Then you have to pay only 17 rand for $1 debt. So then, in rand-wise, it's going to be cheaper for you. You're still going to pay him $20, but rand-wise, it's going to be cheaper. because you're going to pay less rands to pay for $1 debt. Then, if you're going to pay the debt on the 31st of December, the financial year end, then you're going to pay more dollars because the rand has weakened. You have to pay more rands than on the 1st of December. Your rand value has weakened. How could I say that? To pay $1 debt on the 1st of December, I only had to pay 17 rand. But because the rand has weakened, I have to pay on the 31st of December more rands, 2 rand more for $1. So my rand has weakened. But if we compare the 1st of November with the 1st of December, the exchange rate there, what do we see? We see that on that date, on the 1st of November, $1 cost you 18 rand, and then 1 month later, $1 cost you 17 rand. So in that case, has the rand weakened or did the rand strengthen? I repeat the question. On the 1st of December, did the rand strengthen or did the rand weaken? Mr. van Rensburg, what do the people say?
Mr. Bowman, we've got a lot of clever students here. I've got Lihle, Sisipu, Sitembele, Mhlanga. They all say strengthen.
Good. The penny has dropped here. Now, required. Number 1, what would be the amount Selfie Limited would have to pay if settlement happened on the 1st of November 2020? Now, yes, we know the amount we will pay will be in $20. But what I actually want to know, what would be the rand amount? The rand amount to pay if settlement was on the 1st of November. And in all of these questions, I want to know the rand amount.
Bowman, we've got Austia, Lihle, Mhlanga, Sinasu, Chitino. They all say 360,000 rands.
Absolutely correct. Absolutely correct. Let's look at the calculation. For those of you who don't know how to convert the dollar into rand, you take $20. You divide it by the known currency, which is in this case dollar. And you multiply it always with the item you would like to determine. And you would like to convert it into rand. So you multiply it with 18 rand. And that gives you 360,000 rand. So I say multiply with the currency you want to determine. Rand is in this case. And what was the exchange rate? The exchange rate was $1 is equal to 18 rand. So you divide the debt, the amount you'd like to pay, 20,000, with $1 and multiply with the currency you'd like to determine, and that's 18 rand, and that gives you 360,000 rand. Thus, in rand, your payment would be 360,000 rand. Right. What happens when settlement happened on the 1st of December? What was our currency on the 1st of December? $1 is equal to 17 rand. Quickly do the calculation for me. Remember, $20,000 divide by $1, multiply with the currency you'd like to determine, 17 Rand, and that gives us 340,000 Rand. Are you happy? Again, multiply with the currency. Multiply with the currency you want to determine, Rand in this case. And then the last little one, the third one, if we had to pay at the financial year end, what would be our debt at the financial year end if we had to pay on that date? Our debt would have been $1 is equal to 19 Rand. So, settlement on the 31st of December. Multiply with the currency you'd like to determine, the local currency, and your debt would have been, the amount you would have paid in Rand value would have been 380,000 Rand. So, this exercise was purely there to explain what? To explain that depending on your currency fluctuation, you could pay 360 Rand if you immediately pay the debt. You could pay 340,000 Rand if you pay 1 month later. And if you pay 2 months later, you might have paid 380,000 Rand. Because what happened? From 1st of November to the 1st of December, the Rand has strengthened. So if the Rand has strengthened, you are paying less for your debt. And then from 1st of December till the 31st of December, at the end of the month, the Rand has weakened. You have to pay more Rands to pay off a 20,000 debt. Okay, exchange differences. An exchange difference arises when the settlement date occurs after the transaction date. By the way, ladies and gentlemen, Mr. van Rensburg already has received this note. So when he posts the recording of today's class, he will also post this little note there. So, an exchange difference arises when the settlement date occurs after the transaction date. You already know, Mr. van Rensburg explained that you've got your settlement date, you've got your reporting date, and you've got your transaction date. Now, whenever you are paying on the transaction date, whenever you are paying on the transaction date, as in this case, 1st of November, you will simply pay the exchange rate of that date, and you will have no exchange gains or exchange losses. But if you're going to pay 1 month later, you're going to have an exchange gain if the Rand has strengthened, and I'll explain that very carefully just now. Or if you're going to pay 2 months later, you're going to pay more money. So you're going to pay from 360, or from 340, it can increase to 380. So you will even pay 40,000 Rand more, depending what you're comparing. So, e.g., the foreign transaction happened on the 1st of November, but the payment, settlement, only occurs on the 1st of December. The monetary amount payable to the supplier of the goods on the 1st of December is affected by the movement in the exchange rate after the transaction date. any increase or decrease in the amount payable is recognized in the profit and loss account. So, ladies and gentlemen, if there's an exchange difference because of a fluctuation in the exchange rate, you will take that exchange difference to the profit and loss account. So you will have either a profit or a loss disclosed in your profit and loss account. So now I'm going to explain the foreign exchange losses, and then I'm going to explain the foreign exchange gain. And then we're going to look at the ledger account and how we're going to record a foreign exchange gain. And then we're going to look at the ledger account and how we record a foreign exchange, I think a gain again. No, this one is wrong. This one is wrong. It should be a foreign exchange loss. Okay, ladies and gentlemen, let's look at foreign exchange loss. An increase in the amount payable to the foreign creditor will bring about a foreign exchange loss. If the rand weakened, deteriorated, more rands would have been paid to pay off the debt of the foreign creditor. Okay, so the first thing to remember, if there's an increase in the amount payable to the foreign creditor on the 1st of December, there was an increase in the amount payable to the foreign creditor. And it was due to the fact that the exchange rate deteriorated. No, that was on the 31st of December. Let's just look at the example. Compare an exchange rate of $1 is equal to 17 Rand to $1 is equal to 19 Rand. When was the exchange rate 19 Rand? 31st of December. When was the exchange rate 17 Rand? The exchange rate was 17 Rand on the 1st of December. So if we compare 1st of December with 31st of December, there's an increase in the amount of rands. The rand has weakened. Can you see that? So we say, if there's an increase in the amount payable to the foreign creditor, you will have a foreign exchange loss. If the rand has weakened or deteriorated, more rands will have to be paid. With how much did the rand deteriorated in this case? From 17 Rand to 19 Rand, you have to pay 2 Rand more because the rand has weakened. So here's a little explanation. In example 1, on December 1, the spot rate was 17 Rand and payment would have been 340 Rand. On 31st of December, the spot rate was 19 Rand and payment would have been 380,000 Rand. And that brings about 40,000 payment of more to settle the debt. Okay, now I'm going to go to example 2. And I'm going to look at the ledger account. I said, on the 1st of November, Selfie Limited purchased inventory from American company, USA Limited, for $20,000. And we only have 2 spot rates. And we say, on this date, on the 1st of November, the spot rate was 18 Rand, and on the 1st of December, the spot rate is 17 Rand. Has the rand weakened or strengthened? Ladies and gentlemen, tell me, has the rand weakened or strengthened? Mr. van Rensburg, what do they say?
Yes, they are clever. They said strengthened.
So, what happens if the rand has strengthened? You're going to have a foreign exchange gain. If the rand has strengthened, there's an improvement in the rand value. You're paying less rands. You will have to pay off the debt you have to pay it off, the debt of the foreign creditor, you're going to pay less. So in our example, on the example 1, we had on the 1st of November a spot rate of 18 Rand. The Rand has strengthened to 17 Rand. And the difference is where we would have paid 360,000 Rand, we are only going to pay 340,000 Rand. And therefore, the change from 18 Rand to 17 Rand, the change, 1 Rand change, if you multiply it with $20,000, you will see you're going to pay 20 Rand less must be paid to settle the debt. Right, so in question 2, let's say again, our debt on the transaction date was $1. For $1 you owe, you have to pay 18 Rand. So if we record it in our account, here's my foreign creditors account. Foreign exchange creditor, US Limited. Note, this is the supplier's account, and we are working in the books, and we're only going to work in the books of the purchaser. Record the transaction for the year ended in the books of Selfie Limited. Okay? We're going to record it in the books of Selfie Limited. Just want to shift down this. Okay, look at it. Books of Selfie Limited. Foreign exchange creditor. That's the books, the creditor's name, US Limited. And please write foreign exchange creditor so that we know this is a foreign exchange creditor. Or if you don't want to write exchange creditor, you could just say foreign creditor, US Limited. Because we must make a distinction between who is a foreign creditor or who is a local creditor. Now, the way we're going to record it, we're going to debit inventory with 360,000 Rand, and we're going to credit the creditor's account, just like we always recorded credit purchases. Now, I didn't really say here that we are doing the perpetual inventory system. I should have actually said it in the question. So let's just put there in brackets. Perpetual inventory system. Right, ladies and gentlemen, what happens next? Selfie, on the 1st of December, Selfie Limited paid his debt in full with USA Limited. Settlement date, 1st of December. 1st of December, before the financial year end. So, the rand has strengthened. So what do we expect? We expect a foreign exchange gain. So the amount we're going to pay is, how did we calculate it? We would say it is the 360. How are we going to calculate it? The dollar value of 20,000 rand multiply with, you would like to express it in rand, and the foreign exchange rate is, the rand value on that date is 17 rand, and therefore we will have 340,000 rand. So, balancing figure, if you want to. But in the journal entries you're going to do eventually, you will have to calculate it. So if you're going to calculate it, this always works. I always start with what was the debt minus what is the debt now. With other words, what was the debt on 1st of November and minus what is the debt on the 1st of December. The debt on the 1st of November was 360,000 rand. And what is the debt now? What am I paying now? I'm going to pay now 340,000 rand. And the difference is a positive 20,000 rand. So my foreign exchange gain is 20,000 rand. There we have it. Any questions? I could also calculate it by just saying 20,000 rand, sorry, $20,000 multiply with the change in exchange rate, which is 1 rand, and that gives me 20,000 rand. You happy? You happy with the entries? So you would credit foreign exchange gain 20,000 rand, and that account will close off as an income to your profit and loss, or income in your statement of comprehensive income. Let's go to our last question. Seems as if our time is running out now. Example 3. Just remember, example 3, that part is not correct, and I will correct it, Mr. Van Esberg, before we post it on Blackboard. I will send you another example. Right. Example 3. The transaction is on the 1st of November. Selfie Limited purchased inventory from an American company, USA Limited, for again $20. So our entry, foreign exchange creditor, will be credited with the rand value, because in our books we don't show dollars, we show the rand value. Although we're paying in dollar, we show the rand value. And what is the rand value on, or what is the spot rate on the 1st of November? The spot rate is 17 rand. If we multiply it, it's again November the 1st, credit the creditor, USA Limited, debit inventory, and again, we assume it's a perpetual inventory system. Then, next step, 31st of December, we're going to pay in full USA Limited. But, ladies and gentlemen, on this date, the foreign exchange rate is $1. The spot rate is $1 is equal to 19 rand. Did the rand weaken or did the rand strengthen? Come on. Did the rand weaken or did the rand strengthen? Type for me in the chat box.
Got replies there from N. Mhlanga, from Lee Chandre, from Sisipo, from Litle, from Erasmus, and they all agree that it weakened.
Good. So you're going to pay more. And how do you calculate it? Multiply $20 with 19 Rand, and that gives you 380,000 Rand. Now, if we look at this account, remember we are working in the books of the purchaser, and the account is the account of the foreign supplier. The difference, we don't owe any amount anymore. So we had to pay more for our $20 debt. So we made a loss. And therefore, on December 1st, we're going to have a foreign exchange loss of, and now we can calculate it. What do I say? Take the was figure, the debt was 340,000 Rand, minus the is, the current debt. The current debt is 380. And if you subtract it, you get a negative 40,000 Rand. And what does negative mean for us? Loss, eh? So this is just my way of explaining it. You don't have to do it this way, but it always works. If you put was minus is, and then if it's negative, you know it's a foreign exchange loss. It's the dummy way. But you should know that by just looking at your exchange rate difference, and you see that your rand has weakened. If the rand has weakened, you know you're going to make a foreign exchange loss. And in this case, the foreign exchange loss is 2 Rand multiplied with $20,000, and that gives us 40,000 Rand. So on the credit side, we would have an entry, foreign exchange loss, credit, the USA Limited account, and then debit the loss account with 40,000 Rand. Ladies and gentlemen, in these two examples, example 2 and example 3, I've attempted to explain how does a foreign exchange loss occur, how to calculate it. There's two ways, the was-is way, or the way where you just say, my rand has strengthened, my rand has deteriorated, and I look at the difference and I say, okay, that was my original debt, multiply with the difference, and then I could calculate my foreign exchange loss in this case, or my foreign exchange profit. Do we have any questions at this stage? Mr. van Rensburg, there will be another class on Thursday night. If you can't log on to that class, you can just listen to the recording on Friday. Ladies and gentlemen, then we're going to start doing one of those 4 questions in the handout, which you will also get on the online section, or which is part of your handout on cash flows. Mr. van Rensburg, I'm going to stop sharing my...
Mr. Bowman, before you stop sharing, sorry, Zuki, I've told you we've got clever students and they are very awake. So Zuki has just posted a little message here that in the account that you've just corrected, you must also correct the total still.
The total. Okay. Thank you very much, Zuki. I will, when I correct it after the class, I will correct and make sure that it's correct. Mr. van Rensburg, I'm done for today. Do you have anything to say?
No, Mr. Bowman, I haven't got anything to add now. We are obviously going to carry on with this on Thursday and into next week. So I'm also very impressed that we actually managed to finish within our 2-hour slot. That doesn't happen always. Tino has just asked her, is this handout available on Blackboard? Not yet, Tino. We must just update it, and it will be available, let's say, by this evening.
Thank you, Mr. van Rensburg. I'll send the corrected handout just now to you. Bye-bye, ladies and gentlemen. Bye, Mr. van Rensburg.
Bye, Mr. Bowman. Thank you for the class.
Thank you. You may stop the recording.